Hello and welcome to the Advanced Projections July 2022 Economic Report. For this release, we waited for the June inflation figure that was announced on July 13th so as to keep this report as up to date as possible. So thanks for your patience. Now a review of the June economic data highlights. Employment figures for June came in with a still solid new jobs figure up 372,000, which kept unemployment unchanged at 3.6%. We are essentially back to the same labor picture as in February of 2020, just before the pandemic. These levels have the Fed fully focusing on inflation, as was confirmed by Chairman Powell way back on March 2nd and confirmed by another Fed governor's presentation in Germany on May 30th. Annual inflation through June was announced on July 13th with consensus expectations for it to be about 8.3%, and the actual value was 9.1%. This was slightly above our own expectations, and we expect to see another 8.3 to 8.8% figure for July as well. The FOMC June 14th and 15th meeting confirmed our expectations of an aggressive Fed plan of action to address high inflation as unemployment continues to stay well below 4%. At that time, the FOMC announced another increase in the target Fed funds rate from 0.75% up to 1.5%. by adding 0.75% to the earlier June rate, with accompanying plans for additional increases of similar size in the near term. Minutes of the June FOMC meeting revealed that the Fed will be resolutely contracting the money supply by unwinding its balance sheet, removing $100 billion or perhaps more per month. They also indicated that they do not currently project inflation to be taming down to near 4% until 2024, about the same time they believe unemployment will move up towards 4.5%. At the end of this report, we repeat and emphasize our historic warning based upon our expectations for an increase in the vigor of Fed upward interest rate moves, plus the international political, oil, and now food price shocks. With the additional concerns about recession now widely circulating in public discussion, markets will likely keep pointing downwards for several months. Later in this report, we present a first pass estimate at a charted landing zone for the S&P 500. For our indicator status at the end of June, 4 of our 6 indicators have now moved from their prior first quarter status, pointing further at the increasing probability of a recession. Our indicator system moved our recession risk level from 75% to 80% this month due to first quarter GDP and productivity contractions, expectations for continuing downward trends in equities, liquidity, consumer confidence, leading economic indicators, very hawkish Federal Reserve monetary policy, and a newly read AP Fed stability indicator. Unemployment's dip below 4% over the past several months is maintained, remaining at 3.6%, with new job gains in June of 372,000. We expect those gains to continue in a more restrained fashion, with the Omicron wave essentially under control and continuing with the summer weather. The June report included hefty increases in hiring in leisure and travel industries. We had been seeing others project that unemployment will reach 3.7% by the end of the year, but clearly it's already below that. And our own figures fell into the 3.3 to 3.5% range, and we are still nearly there. There still remains approximately 2 job openings being advertised for every unemployment person who is looking for work. Year-over-year consumer price indices increases and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies. CPI figures confirmed the onset of inflation during the second quarter of 2021, and they have continued to rise. This March's number was 8.5%, April was 8.3%, May hot at 8.6%. Last month we said everyone should expect at least a few more months that are in the range of 8 to 9%. Per that projection, the June inflation number came in hot and high at 9.1%. With the June 15th Fed FOMC interest rate announcement, our previous month's forecasts of 0.5% rate bumps were moved up to 0.75%, as we now expect for the next rate increase to be announced in late July. Given the well above expectations inflation number for June, the Fed may be forced to shock the markets with an even greater increase of a full 1% at their meeting at the end of this month. There will be a 2-month gap between the July and September meetings, so these moves would be designed to have a significantly greater impact than 3 consecutive monthly increases of 0.5% or more. By the time the FOMC announced their June rate hike, the yield curve had already priced in a 50-point move, with every element of the yield curve moving upwards between May 30th and the June 15th rate hike. The latest inversion that currently exists is a minimally growing one, where the 3- and 5-year yields now exceed the 30-year by about 0.16%. The rate spread that we watch, 3 months versus 10-year yields, has contracted from a spread on June 2nd of 2.09% to a June 15th difference of 1.59%, and now to a July 13th difference of just 0.2%. So that has shrunk by 3/4 of its full spread just 6 weeks ago. And further contraction in this spread is expected through the summer, just as we would expect ahead of any recession. Our yield curve indicator would be solidly into the yellow today, and with the way rates are now changing daily, will be solidly there through the end of July. We now anticipate a full inversion and red status before the late September Fed FOMC meeting. Second quarter corporate earnings estimates for 2022 have been tempered substantially, dropping by 1/3 since the beginning of the quarter, and are continuing to be revised downwards. Companies have now returned to the practice of citing lower expectations in the coming quarters. With recent earnings calls, over 80% of the S&P companies cited inflation as a high concern, certainly with regards to material costs, as well as labor costs, and anticipated continuing upward pressure on those elements. Now, we were the first to say that analysts were clearly not yet fully factoring in what we expect to be significant real declines in consumer spending due to inflation and rising interest rates. At this point, just ahead of the onslaught of second quarter reports, no one has come out with any serious or broadly applicable earnings downgrades. It is, however, inevitable that it will happen shortly. As of this publication date, we have only seen a few companies reporting out of the S&P 500. For example, Delta Airlines missed its earnings estimate by more than 12% in spite of heavy sales volume due to rising fuel prices. But the peak of those prices has already passed now, as we illustrate in an oil chart a little farther down in our report. Now, here is the current underlying socioeconomic detailed picture. Bureau of Labor Statistics employment and the Federal Reserve's intentions. During June, again, the unemployment stayed at a level of 3.6%, with an about as expected jobs gain of 372,000. That combination translated into a continuing trend of more job seekers re-entering the jobs market. In spite of past pandemic-related declines in the labor force, the participation rate began to move up again beginning in the late fall of 2021, and it continues to move up, as is the total number of employed persons. We have the usual BLS household data table, which is included in our report and shows current levels from the end of June and compares those to 1 year ago as well as the last trends over the last 3 months. The current high employment situation also keeps the Fed free to be as aggressive as they deem necessary in their rate increase script, plus their plans for unwinding their balance sheet, which means a decrease in the money supply. They have already stated so with their March, May, and June rate increases and within their latest FOMC meeting minutes. Look for increased activity in these areas during this summer. Now note, as is usual in the hindsight-based discussions in the popular financial media, there's a lot of criticism of the Federal Reserve for not addressing incipient inflation 1 year ago when the CPI index started to increase faster than normal. We do not criticize them in hindsight at all, and here's why. The Fed prioritizes employment levels over inflation when the former, that is employment, is in a bad way. A bit over a year ago, unemployment was still 6% and declining slowly. The Fed wants to have unemployment at 4% or lower when they start increasing rates, so there is some wiggle room in employment as the economy slows down in response to their rate increases. The June 2021 unemployment was unacceptably high, near 6%, so there was no wiggle room at all at that time. This precluded them from beginning any form of tapering program at that time and throughout the middle of 2021. What happened after that, while unemployment slowly declined towards 4% by the end of 2021, were two new sweeping waves of the pandemic which could hardly be anticipated by anyone. The Delta wave was quite deadly and certainly capable of threatening any fragile recovery in the economy, so the Fed's hands were still tied. They could not create any premature expectations of tapering until the further threat to public health was seen as limited. The Fed provided a fairly gentle tapering script in November 2021, around the time Omicron was spreading through the population. The markets and the economy basically ignored that script until new inflation figures came in and made the Fed accelerate their script in December of 2021. This finally sank into the heads of investors who began leaving the markets in early January of this year. The increasingly aggressive rate increases that began in March, sequentially 0.25%, then 0.5%, then 0.75%, are doing what they are intended to do. That is, allow skilled planners and investors to adapt to the new environment and have some forward-looking perspectives about the economy. June's 0.75% interest rate increase has already had a significant effect on the price of oil, for example, driving it down about 22% so far and hitting energy exploration equities hard as well. As we are facing further significant rate hikes, this is very likely to be a continuing downward trend, with oil potentially back below $80 by the end of the third quarter of this year. Also look for replenishment purchases for the Strategic Petroleum Reserve to begin later this year, which would temporarily support prices. And we have a chart which shows crude oil prices as of July 13th, down from $123 to just below $96. We expect that trend to continue. Regarding equities, in our June report, we said this: we expect further downside to the S&P and other indices over the coming weeks. Breaching of official bear market levels of minus 20% are highly likely by the end of June. Index volatility is also to be expected. While that prediction has come to fruition. During June and through the first half of July, the equities markets continued on a volatile but downward path, setting new 2022 lows back in mid-June and now approaching them again in mid-July. Between 2022 highs set very early in January and closings on July 11th, the Dow Industrials were down 14.2%, solidly in correction territory for now. The NASDAQ is down more than 27%, and the S&P 500 bounced up a tad from minus 21%, with both the NASDAQ and the S&P in officially bear markets. We expect significant further declines in equities and bonds. A return from the current still in the bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 2900. In a typical bear market, negative emotion moves carry enough downward momentum to drive indices significantly below the mean, towards and through the inevitable retail investor emotions of despair and capitulation when finally the selling ends. There is no current reason to expect anything different this time. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. Margin borrowing is finally moving off of historic highs and decreased by 3.6% in March, 3.3% in April, and 2.6% in May. This is continuing evidence of something that is seriously discouraging even more of the risk takers from borrowing to finance equity speculation. Now, the pandemic in brief. By the end of March, total U.S. COVID fatalities reached over 1 million. However, the daily new case and fatality rates have finally declined to less ominous levels. COVID-related hospitalizations, ICU occupations, and fatalities of victims continue to decline during June against the backdrop of a recent small uptrend in new cases identified. Thankfully, new daily fatality rates have declined substantially over the past several weeks. Barring any nasty new variants that could pop up, we should expect a general domestic return to normal for tourism and other social activities during the remainder of summer. For example, we point to the robust hiring found in the leisure and entertainment sector during April, May, and June. Our expectation for the end of the pandemic, barring any aggressive new super variants, was for the average U.S. daily fatality rate to fall below 400 per day and stay there. So far, so good, as the most recent 7-day average was below 300, less of a horrific number. This is well within the ability of our social fabric to tolerate given new and more effective treatments or preventatives. This sort of fatality rate puts COVID on par with nastier seasonal influenzas, but we are not making the mistake of trivializing the consequences of COVID on the more vulnerable. If the current Omicron variants of concern remain as manageable and minimally fatal infections, we will keep watch over it, but no longer report on details of the pandemic and its evolution. Should that not be the case and something nasty pops up again, we will, of course, include it in our analysis of progress and effects in our reports. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.